Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at the Exchange ETF conference. Joining me for this segment, we have Jeff Sherman. He's the Deputy Chief Investment Officer at DoubleLine Capital. Jeff, it's great to meet with you. Welcome to Trade Talks.
Yeah, thanks for having me.
And what a difference a calendar month makes. I mean, even the composure of the market from 3 months ago looks certainly different. Give us some of your thoughts on the macro here.
Yeah, so what you had roughly 3 months ago was the bottom in markets, right? There was the high-end yields across most points of yield curves at the front end. You had a low-end stock market, and you had spreads extremely wide at the time. And if you go back at that time, we were saying this is a very ripe opportunity for bonds. It's the cheapest they've been in over a decade. And so that still is true that they're cheap. They're just not as cheap as they were because we've had a nice little rally. But that said, putting a portfolio together today, investors were struggling to find income, right? Think about it, a year ago where we were in income. I mean, there's hardly any yield out there. You had to stretch to get anything. Now T-bills give you a higher yield than the high yield market did back then. So I think what you're seeing is that there's a resurrection of investors coming back to the bond market. We always blame tax loss selling towards the end of the year and the likes, but it really seems like it was true to form this year. And so what was the catalyst for that is really the inflation data started to come down, right? And so this disinflation, I heard Jay Powell say disinflation like over 10 times last week, right? And so what you're seeing is that the bond market is sniffing out the inflation narrative and saying, okay, it looks like it's getting more under control. And what that's done is that's been a catalyst for rates, for credit and risks to also rally as well. Because the thing that was the challenge last year was rates. Right. Now rates are the tailwind, and therefore it's helping out. Even if rates stay range bound, and I think they will in the short term, that they'll stay in this range, that's actually good for credit as well, right? Because you don't have the volatility bounce. If we stay range bound, there's more certainty in the market. That means people are more willing to take more credit risk. But the rally you've seen in the last month or so, and again, this is absent the last couple of days, right. But what you saw was that it was the lower quality. You're starting to see that signs of, okay, it's either going to be a recovery or it's a head fake. And the jury's out on that still right now.
Yeah, well, it's interesting. I mean, when was the last time we really spoke about 60-40, right? I mean, that kind of has worked this year with both bonds and equities, moving higher in tandem here. Yeah. Tell us about balanced bond portfolios.
Yeah. So, balance gets a weird name, right? You think of like the 60-40 as the balance, but what we're talking about in a bond portfolio, and specifically our ETF, is something that owns credit. Right, it wants to own some of the credit risk because, again, if we're kind of range bound, some of that inflation's behind us, spreads maybe don't tighten in, but there's a yield advantage, right? There's something good to own, especially if you underwrite the credit well, you have a deep team that can do all this stuff like all of us can. And so it's very important to own that piece right now because you get paid for it. You can build a high quality credit portfolio that yields in the 6.5 range today, right? Diversified across a lot of sectors. But it has risk, right? It has recession risk. We know the yield curve's inverted. Like a lot of the leading economic indicators are negative, right? So there's a lot of things that say maybe they should be high yield at this point or higher yield because of that risk. Well, how can you get comfortable with that? You can balance the risk. And there's two parts of the market that usually work in a risk-off environment: Treasuries and agency mortgages. And if you take those two components, you can buy stuff that has duration, right? That would actually rally if bad things start to happen. And by the way, the credit I'm talking about isn't trading at par. The credit trades in like the low 80s, maybe the high 70s. And bonds, one thing you know about them, if they don't default, you get 100 back, right? So there's this embedded yield inside the market that you don't even see. Yeah, we trade on yield to maturity and things like that. But what you find is that there's a lot of upside, but it also means that if bad things are starting to happen, maybe there's not as much downside. Right, so it's tilting those two things together.
Right, and you know what? We keep talking about active management. This has been a key theme this year, and it feels as if PMs are going to absolutely have to be very tactical this year, more so than it's felt before.
Yeah, and I've been saying that we're at an inflection point right now, and it's not clear to me right now which way we're going. Are we having the recession? A lot of the indicators say it, right? And I don't dismiss them, but maybe they're a little distorted because we have the upside. But the other side of it is, what if we muddle through, right? We've seen the jobs, the labor market seems to be pretty dang strong, right? We saw services bounce back on Friday. And so if the market's going to continue, or let's say the economy is going to continue to perform, we don't get this increase in unemployment, it's hard to say we're going to have a recession. But I think the data is going to tell us something in the next few months, right? And either we're going to stay on this trend of this kind of disinflation, lower inflation, and rates offer a very good value, and bonds offer very good value, or it's going to sneak back in the market a little bit, cause some problems, and maybe scare the Fed a little bit. But Jay Powell is speaking today. I only got the headlines that have been here, and I asked my team to give me some summary. It's like he didn't change his mind. The bond market kind of repriced in the last couple of days, and he's like, I'm fine with it.
Right.
He seemed very relaxed.
Well, he's been, one thing you've got to give him is he's been incredibly clear about telegraphing his message.
Yep.
Sometimes, is the market getting it right? Is it getting itself ahead of the Fed?
Look, the market is going to interpret the Fed, and it's going to start to price things, right? So the Fed is telling you they're going to 5. They're going to 5.25. They want a 5 handle, right? Market says you can go to 5.25 now. After the repricing on Friday and Monday, we got the market really right on line with where the Fed's talking. So the market knows it. It's priced. Why is the curve inverted? Is it because it's recession?
Right.
Or is it because the bond market is saying that inflation isn't going to be rampant, we're not going to run at these high levels, maybe we go to a 2.5%, 3% inflation rate, and if that's the case over the longer term, you get a real yield out of it. So maybe some of the work that the bond market's been doing is helping signal to the Fed, right, that you're going to have to come down at some point. Now there's pricing in the market. If you look at it, it says that there's a cut on the back end, but that's not how markets work. They don't trade averages. Someone's making a trade. Right? So if there's 35 basis points of cuts priced in the back half of the year, that's maybe someone saying, I don't know, there's a 10% chance that the Fed cuts 350, right? Because they're not going to cut 25, they're not going to cut 37, right? They're going to move if they move. So when people start to look at that pricing, you have to remember that it's someone making a trade as well. To do that, they're playing a big convexity, a big payoff, right?
And to your earlier point about this is the inflection point, it seems as if that yield curve really is the variable that you're going to have to pay attention to when it comes to that because of that inflection point in the scenarios that you pointed out.
Yeah, and what I look at is the labor market too.
Right.
So we only get non-farm, the establishment survey once a month, but you get unemployment claims every week, right? You get them every Thursday. Some are lagged 2 weeks, some are lagged 1. But the point is, you get updated data pretty frequently. The unemployment claims have been really, really low, right? We're at pre-pandemic levels, lower than that, and both continue that, and we see the strength in the market. So the question is like, labor's always the last shoe to drop. Companies get rid of people because their business is bad or they're in a recession, they're struggling. They don't do it because they think there's going to be one, right? And so the problem with using labor as an indicator is it's notoriously laggy, right? But also, if you think about the health of the consumer, again, there is more in credit cards, there's more, kind of in just debt in general, but a lot of it is fixed rate financed, right? Mortgages, right? Everybody got to refinance because rates were so low, we all enjoyed it. There's no reason to refinance now because you'll have to pay a lot more. So that helps the positioning as well. So again, I think all the things that are metrics that I can make for the bullish case right now, they go away in like 8-9 months because that starts to linger a little bit farther. Time is the enemy, right? Because the debt burden comes around, the maturity will all show up. So I'm not concerned today, but what helps me own that credit and be worried about it is the other side of the trade. It's if the bad things happen, because of where yields are, we have a strong conviction that says those can rally in a meaningful manner.
Appreciate the insight, Jeff. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.